Hello everyone, welcome to the monthly webinar. This is Chris Capre with secondspecialforex.com. I want to thank you all for joining us. This is the only webinar today, and so I want to thank FX Street for allowing me to have this webinar here. It's always great to work with you guys again. So today's webinar, the open portion of the webinar, it's really split into two portions. This is a monthly webinar. It's something you do once a month where one speaker pretty much gets to teach one large class. And so we have back-to-back hour-and-a-half classes. The first class is on advanced price action trading. And so we're going to talk about that. Hopefully you have some familiarity with price action trading. If not, I'm going to be going over that in the beginning. Before we do get into the actual content of the webinar, I want to let you all know, first of all, I love a very active discussion and participation. So if you have questions at any point in time, if your questions come up for you, ask them in the chat section here. That's what this is for. So yes, we're not talking to each other, but I'm really good at answering questions on the fly. And so with that being said, feel free to ask questions. It's what makes, it's what enhances the learning process. And so, with that being said, you know, the more active you are in your learning process, the more likely you are going to learn the material. That is why I was always sitting at the front of every single class I was ever in college. I was always in the front row because I wanted to be the most engaged. I wanted to be very active with the professor, and I wanted to really understand the material. So my education was very important. And it's the same thing here. So by being active and participating in this, you increase the chance that you will digest the material on a different level. So with that being said, and so we already have a question right off the bat before we've even gotten into the material. I love it. There's a question from Panta. Fantastic. I asked for questions and you guys aren't even holding back. This is awesome. Panta asks, Chris, is this the only moving average you use? It's actually not the only moving average I use. I have other ones, but the only time I use other moving averages is for proprietary systems. So other than that, I don't have indicators that are up there arbitrarily. I only have indicators that are up there based upon a system. So if I'm ever doing analytics, and I'm rarely ever doing analytics in the sense of, okay, where do I think this is going and this and that, you know, I don't really do that at this stage in the game anymore. At this stage in the game, I have systems that I'm very confident in because I've been trading them for a long time. And so with that being the case, I trade the systems. And so the systems have by design, some of them have indicators, some of them don't. And so if they have an indicator on there, I'll use it. But if the system doesn't have an indicator on there, I will not have another indicator up there for extra analysis or extra confirmation. I don't need that. And actually, that's kind of what this class focuses on, is by having less indicators on there and really understanding the nature of price action. So, so hopefully that answers your question there, Panta. This is not the only EMA I use. However, if it's a standard chart or anything like that, the 20 EMA is the main EMA that I will use. And so even though we got a lot of material, I'm also going to leave this sort of free form at the same time because we have an hour and a half. I think we can definitely cover our material even though it's a lot. So I'm going to take a few moments here just to ask a few questions because these are some good ones here. And in terms of Ed's comment about the CPI, I'm generally not going to make comments about fundamentals, mostly because I really don't spend that much time monitoring fundamentals. I spent a lot of time monitoring fundamentals when I worked for the broker, and actually had an entire month where I was assigned to study two currencies, the Aussie and the Kiwi, strictly on a fundamental basis. And after really just watching the market and studying every single fundamental indicator you could possibly imagine, I found that they weren't as important as they were really kind of made out to be. They do make things a little bit more exciting in some sense. You know, you can like, oh, this announcement's coming out in 5 minutes, and oh, you know, well, if this happens, this could happen. You know, it's sure we could always come up with all kinds of interesting scenarios, but the bottom line is it doesn't really matter who is involved in the market, whether they're really concerned about the fundamentals or not. That's all present in there. So with that being said, I haven't lost anything. So I'm really not going to spend any time in this class talking about fundamentals. It's not something I'm really interested in. And I really, after my studies in it, wasn't able to find enough correlation between fundamentals and movements in the short and medium term. Okay, so Bob has a really interesting question. How long did it take you to become a consistent, profitable trader? That's a good question. It's a good question because I actually, for the first 6 months of my trading, was consistently profitable. I actually had a 6-month trading streak where I was trading between 60 and 80% accuracy. So in a sense, and that was the first 6 months of my trading. So in some sense, it didn't take me any time. But my period, in terms of how I went through cycles, that's for sure. And eventually, there was a certain stability that just kind of came through. And the stability wasn't necessarily a factor of time. The stability and consistency in my trading really became a factor of 3 variables. And the first one was being really disciplined in my risk management. That was the number one thing which brought stability to my trading. There's nothing worse than having, a week's or a month's worth of gains erased by one trade. And I realized that just doesn't work out. Another reason why I was able to really understand risk management is because one thing I like to do is I actually like to play blackjack. And I've studied a lot of the mathematics and statistics on blackjack. And so with that being the case, when blackjack, there's these guys who play on gut feeling and things like that, but the bottom line is it's much more effective to play the numbers and the statistics. And you always want to play them in your favor. You want to do everything you can to move the advantage and the edge to your side and not the house's side. So as I became very familiar with understanding how to play blackjack from a very mathematical perspective, it really taught me the value of risk and how important it is to do that with my trading. So once I got really disciplined with my risk management, that brought an incredible amount of stability in my trading. The second thing was really from there being disciplined in following a strategy. I had a few strategies that I was following, and a lot of times I would deviate from them, which ended up causing a lot of problems. And even then, just the other week, I almost stepped out of the discipline that I had built for so long. And I said to myself, wait a minute, this is not part of the discipline. This is not what you're doing. This is an old pattern. Walk away. So the key was to avoid making mistakes that threw me off the track. It's real easy to drive a car, but trying to drive a race car is a little bit more difficult, and trying to stay on the track with a really fast car is not easy. So, the key is first to be able to stay on the track, and then eventually increase the speed at which you can handle driving on that track. So the second thing that really stabilized my trading as a variable was being disciplined in following a strategy. And then the last thing was actually having a strategy that I felt comfortable with, that matched my personality, that really, just made sense to me. And that's the important thing. If you really think trading is about the strategy, you're missing 80% of what trading's about. There are hundreds of strategies out there that are effective. I have traders that I've taught the exact same strategies to use for the last, few years. Some of them have become incredibly successful. Some of them have not. I have one guy who's trading about $93 million, and he's using mostly like 70% of his trading as the strategies I taught him. I have other people that have totally blown the money, totally blown their account. What was the difference between the guy who's trading $93 million and the guy who'd blown his account? The key was risk management and discipline. So the strategy was never really the basis for becoming really successful at trading. The key was finding a strategy that was built around my personality, my mentality, and then trading around that. But the other two things had to be in place for the strategy to be useful. Otherwise, that strategy wasn't useful at all. And so this game is really not about strategies. Everybody spends so much time finding strategies, but they spend no time working on the other aspects of the game. And you actually have to stabilize the other two first before you can effectively use a strategy. If the other two aren't stable, it won't matter what strategy you're using. You will misuse them. And so those were the three factors that were in place that had allowed my strategy or my trading to become stable. And so, hopefully that answers your question there. And I'll answer two more questions, and then I'm going to move on to price action here because that's what we're all here for. So, do I put money at risk every day in the market or just swing trade? More than likely, 90% of the time, I'm trading every Monday through Thursday. So every Monday through Thursday, I'm trading. Fridays are, I would say, less than 30% I'm trading, and Sundays I'm almost never trading. But yeah, for every Monday through Thursday, I'm putting money in the market. Sometimes it's new money, sometimes it's money that's being left in the market. And so, Capre asks, what is the maximum leverage? So hopefully I answered your question there, Bill. Capre asks, what is the maximum leverage that I use? The maximum I'll use is 100, but to me, and this is the whole thing about the CFTC issue, about their proposed thing, is that I think the CFTC is really looking from this from the wrong perspective. I think Andre has a very good, valid point that education is the key, but the bottom line is leverage has never really been the issue with, leverage has never really been the problem in trading. It's really, by making leverage the issue, they're looking at the wrong variable. They're looking at it illogically. And why do I say that? Because, there's this saying that leverage is a double-edged sword. So the key with the double-edged sword is that it can be beneficial or it can be very detrimental. Therefore, since it has equal possibility to be both helpful and detrimental, logically it has nothing to do with either side of it. The key to using a double-edged sword is not in adjusting the edge of one side of the blade. The key is just learning how to use it differently than a single-edged blade. That's the actual thing about it, and I speak from that because I've actually trained in samurai sword fighting. And so that's the thing about it. So the CFTC is really looking at it from the wrong perspective. They're trying to dull one of the edges of the blade so that you don't hurt yourself when the blade swings back. And the problem is that kind of puts a governor on it, but it doesn't really solve the problem. It doesn't stop people from speeding. It just makes it a little bit more difficult for them. The key is to be able to teach people how to use that properly, and that's what Andre was trying to get, and I wholeheartedly agree with him. If leverage really was the issue, then why is 20-to-1 leverage allowed on certain futures contracts? Why are they proposing 10-to-1 on Forex and they will allow 20-to-1 on certain futures contracts? So to me, if they're saying 10-to-1 their argument has to be either that only in Forex is 10-to-1 what we think to be the most valuable leverage, or we're saying across the board 10-to-1 leverage is what is most important. If they're saying 10-to-1 across the board, then they have to make that the maximum leverage for all their instruments. They'd have to adjust that for futures as well. And I don't think that's going to go over very well. So unless they have statistical proof that shows, hey, when you adjust it to 10-to-1 leverage, that actually trading performance increases for people, unless they can really show that, it's an invalid argument. They're just making an arbitrary number up. And so to me, it's a really futile argument. So to me, they're looking at it from an illogical perspective. They're not understanding the logic of a double-edged sword, which is that it actually has nothing to do with either edge. So that's, for me, I use anywhere from 20 to 100-to-1 leverage. Okay. So with that being said, and Yaki, I'm going to get to your question later towards the end there because we've got to get into some price action stuff here. Okay. I know, to forgive me, I'm going to take some sips here and there. My voice is still recovering from the flu. So today's class on price action, I'm going to be teaching you two methods and two strategies. We're going to start off with two methods and then we're going to move into two strategies. First of all, what is price action? Price action is simply prices movement over time. It's kind of the blueprint or the genetic DNA of order flow. Price action solely is created by order flow. It's irrespective of technicals and fundamentals, and price action actually has no bias towards technicals and fundamentals. And so the bottom line is that order flow is what moves the market. And I'm kind of answering Kevin's question at the same time. It doesn't really matter to me whether somebody gets in the market for a technical or fundamental reason. The bottom line is the markets will not move unless the order flow moves it. So that's what price action is really representative of. It's the increase or decrease of price over time as it responds to order flow. That's what price is. Now notice, I'm not just talking about price action in terms of formation, I'm also talking about price action in form of time. Many people spend a lot of time analyzing price action and just looking at pattern or just looking at structure, just looking at formation. And the problem is that misses the other key element, which is actually a key driver or key ingredient of price action, which is time. If you spend all your time studying just patterns, you're going to be missing one of the most important elements of price action, which is time. Price is behavior over time. How does time or how does price relate to time? So you have to understand both sides of the equation. Otherwise, you're really getting an incomplete picture when it comes to price action. You cannot just look at structure. You have to understand price in relationship to time as well to truly understand the full gamut of price action. And so these two methods I'm going to be teaching you play with both sides of that. They don't just look at structure. They're not just looking at a flag pattern. They're not just looking at a triangle pattern. Part of the reason why those patterns aren't totally successful, and some are more successful than others, is because they don't address time. You can use those patterns and find ways to address time in combination with those patterns, but those patterns in and of themselves don't address time as a variable. Only until price action addresses time does it become more complete, and that's what I'm going to be teaching you in these methods. And these strategies will actually be based upon that as well. So we're going to be understanding price action from both sides of the equation. Okay, the first concept, and these are actually part of my book that's going to be released in a little bit, is that, and by the way, por favor, let's not have, if we could avoid comments about such and such, news is coming out, this is coming out, this is coming out. It's not the focus of this webinar. The focus of this webinar is not what news events are coming out right now, or the focus of this webinar is not, hey, you know, this CPI is this, and do you think it's going to have this kind of effect on the market? That's not the focus of this webinar. The focus of this webinar is to teach you some advanced concepts when it comes to price action. And so if we can, let's try and keep as much focused on that as possible. And so that would be great. Of course, we can ask other questions, absolutely. Especially if it has a connected thread, absolutely. Feel free to ask that. But I also want to keep this content streamlined because we've got 120 plus members on here. It's very easy to get off thread. Okay, so these are actually part of something I call BR trading, behavior response trading tactics. And one of them is called frequency. And so frequency is simply the, how could I say, the frequency that the market is being bought up or sold, basically. We can analyze it in both trending and ranging environment. In a ranging environment, that frequency, which with the market is going to be bought or sold, is going to be more balanced. And I'm going to argue that being in balanced markets is actually, you know, when the market is really balanced, is actually the least opportune times to be involved in the market. Warren Buffett once said, when he was talking about the market being efficient, he said, if the market was efficient and balanced, I would be a poor man. It's when the market becomes imbalanced that the greatest opportunities are available to us. Why is that? Because when the market is imbalanced, then that means it has directional bias. And when the market has directional bias, well, then it's very easy for us to make money. It's much easier for us to make money when the market has directional bias than if it has non-directional bias. That's because we trade in one side of the market. We go long or we go short. If you go long and short at the same time, I'd really reconsider that strategy. But if you go long or short, and let's say you go short and the market is already moving short, well, then you have a much higher probability of making a lot of money. If the market's going short and you're going long, you're going to have a very difficult time making money doing that. And so we only want to trade with directional bias, and we want to look for those times when the market is imbalanced. And so when it has directional bias, it is imbalanced. That means that the scales or the equilibrium is heavily tipped to one side of the market. It's not center. And so that's what we're looking for. To find the frequency of the market, and Arash, yes, trade within the trend. Trade with trend, absolutely. Not just within the trend, but with trend. Okay, so to find the frequency of the market, and this is method number 1, is incredibly simple. The only thing you really need to do this is a 20 EMA and a calculator, and that's about it. I'm very lucky. I have algorithmic programs that can do this for me. I paid a lot of money for those things, but hey, that's the benefit I get of that, of having a good program and some money to do that. But the bottom line is all you really need to do to do this is a calculator and a 20 EMA. What is the 20 EMA for? The 20 EMA is to establish the basic directional bias, or to confirm the directional bias. If I didn't have the 20 EMA here on this chart right here, I would not need to be a rocket scientist to figure out the general directional bias is to the downside. However, let me put up that indicator again. It does make it a little more clear visually that the market has directional bias. Now, that EMA that I'm using is the 20 EMA. It's the only EMA I will ever use for price action analysis. As we can see, the general directional bias is clearly down, as we've only had a few violations of the 20 EMA. We didn't need the 20 EMA to do that, but it does help. Now, once we are in an established swing, and that means that the market has clear directional bias, and that directional bias is confirmed by being on one side of the 20 EMA the majority of the time. What does that mean, the majority of time? About 80% or greater on one side of the 20 EMA. Once we have that established, then all we need to do is calculate the balance or the frequency that the market is being bought or sold. In this case, we're in a downtrend. Let's take a look at this from the top to the bottom. Now, if we were actually to look at this from the top to the bottom, I've already done the mathematics on this. So we basically have roughly 63 candles here, 63 candles total, and about 71% of them are red candles. Now, if you had to, and Bill, this is not just for daily analysis. This is for any time frame. You can use this on any time frame whatsoever. Good question. But I will talk about optimal time frames for this. Now, if you were to do the mathematics, about 71% of the time is this thing being sold off. The frequency is very easy. I just take the total number of candles, and if I want to find the frequency, since we're in a downtrend, do I try and count the number of red candles, or do I try and count the number of blue candles? That's a tough question. Which one's easier? Which one do you think is easier for me to find out mathematically the frequency? Counting the red or the blue candles? Okay, a lot of people said blue. The answer is blue. The reason why the answer is blue is because there's less of them. So it's much easier to count the blue candles than it is the red candles. All I need to do is count the total number of candles, and then all I need to do is count the number of blue candles, the non-directional candles, and then divide the non-directional by the total number. That will give me the overall frequency. So in this case, only 29% of them were blue candles, which means inversely 71% of the market was red candles. What does that mean in terms of frequency? That means in terms of frequency, the market is selling off 71% of the time. 71% of the time. Now, if you were getting with trend, you were trying to get in with this trend, we're going to teach definitely a tactic to use that doesn't even actually have to do with the quantitative or mathematical aspects of the price action. But if you were to get in with trend, because the market is selling off 71% of the time, in other words, 71% of these days it's selling off, that doesn't mean you want to get in 100% of the time. That means you'd want to enter in 7 out of 10 candles. That's the frequency of the market, and that's the importance of, that's the importance of understanding the frequency. If it was 65%, then again, just because the trend is clearly established doesn't mean we just get in on any candle. We want to consider the frequency involved. That means that 65 or 6.5 out of every 10 candles, we would want to get in with trends. So by having the frequency, we now understand the kind of numerical or mathematical frequency that this market is being bought or sold. This method actually deals with not just price action, but it deals with time, because it's concerned over time, what is the actual possibility that this market is going to sell off on any given candle. And knowing that 70% of the time, I'm just going to round out, that this thing is going to sell off 70% of the time, that's very powerful information to us. Wes was saying, are these normal candles, black and white? These are normal candles, yeah. I just have them blue and red because I like those colors. It's a little bit easier for me to work with. What period of time? Boyke, I don't totally understand your question there. We're working on a daily chart right now, but I think your question has to do with how do we measure the frequency? And let me get to that. The way to measure the frequency is you just need a clear directional swing. If the swing is completely interrupted, then you wouldn't do it. How far back? To the beginning of the swing. And that's very easy for us to spot because this was definitely not part of a downswing. Downswing started here. So we would start at that point. That's where the downswing started. Okay. So you start at the beginning of a swing. It's not there is no set number as how far you back. You just go to the beginning of the swing. And it's not really hard to calculate swings. If you go to smaller time frames, it is a little bit more difficult to calculate swings. But the bottom line is that you just need to be able to find the general swing and then start from the beginning of that. Okay, now here's the beauty of this. Okay, zoom out one little. Perfect. Now, 71% of the time, this market is being bought and sold, and then in other words, 71% of the time this market's selling off. Now, we're going to do a little test here, and we're going to apply that 70% methodology. The first person to say, first person to type in second skies wins. So whoever can type in second skies the fastest gets to be my assistant for this. Okay, cool. Midships. There we go. Okay, midships. I'm gonna go very slowly on this because I know there's a subtle delay here. I'm gonna move my cursor from left to right. At any point in time, you're gonna type in stop. When you type in stop and I see stop, I'm gonna stop the cursor. Hopefully you type it in before I get to the bottom of the chart. So let's just try this for a second here. Okay, so I am starting now. I'm moving slowly, and I'm looking for your stop, and you tell me when to stop. Perfect, right there. Okay, let's mark this candle. It's this red candle right here. Okay, let's apply. Many people are probably thinking, well, wait a minute. Okay, yeah, top to the bottom swing, he's looking past 10s. It's real easy to say I want to get in 71% of the time. Let's apply that to a random number here. Now, if I were to actually take the numbers from here all the way down to here, from here where the swing starts down to here, I would be willing to bet that the number is pretty darn close to 71%. In other words, this market is still selling off 71% of the time. So let's count the candles. 3, 6, 9, 12, 15, 18, 21, 24, 27, 30, 33, 36, 42 candles. Good, it's a nice even number of 3. 42 candles. Now let's count the number, but it is not a swing end. Absolutely. We're not concerned about the swing end. What we are concerned with is that, hey, let's say the swing is real time, and here we are real time. This is where we're at, real time. Well, we want to know, did 71% of the time apply real time during this little swing right here? It's not about whether we're at the swing end or not. Because there's going to be times where you are in a swing and the swing hasn't ended. You don't need to know the frequency after the swing has ended. You need to be able to calculate the frequency when the swing is in play. I'm just using this as an example. So by being able to calculate the swing frequency when it's in play, You can now apply that for the rest of the swing until the swing gets interrupted or disrupted. We're going to talk about how you can find out when is a swing or its frequency disrupted. It's actually not complicated to find out. There's two tactics. One of them has to do with frequency to find out when is the swing disrupted. Okay, so we have 12 blue candles and we have 42. So 12 divided by 42, is 71%, as Midship's already calculated for us. So we took a random point in time. I had no control over this whatsoever, and the frequency was stable at some random point in time. Is it going to vary a little bit? Sure, maybe a few percent, but the bottom line is that frequency, once you have that established, will stay stable throughout the rest of the swing because the market tends to move in those kinds of frequencies. It may accelerate or it may decelerate a little bit, and that's not that big a deal. It's not that big a deal if it accelerates or decelerates a little bit. What we are concerned with is disruption of that frequency. When that frequency gets disrupted, then we want to be really concerned. And we only need to be concerned if the disruption is against our frequency. If it's in favor of it, all the better. So we wouldn't be concerned with it being 75, 76, 78, 80%. That's more favorable. That just means we have a greater chance of actually getting in a profitable candle. It's when it goes down to like 60, 50, 40. When it gets seriously disrupted, then we want to be really concerned with it. Then we want to see if there's something in place which is suggesting that the market is disrupted. Okay, so with that being said, if we were to apply the 71% for the rest of this, we would probably make money. That frequency would still hold. And it would have held here too as well. So finding the frequency gives you this numerical value to time the market. It makes it a lot easier. It answers one of the most important questions, is time. When you're trading, you're really just doing three things. This is all you're really doing when you're trading. You are trying to find the where you want to get in, the location, that's called location. You want to find the direction. Generally, you want to find direction first. First thing you want to find out is direction. Then you want to find out the where. And then once you figure out the where, the last component you ever really need to figure out is the time. And so with that being said, that's all you really need to do. We've already established direction. We've already established a general idea of the timing of it. Now we just need to actually find the where. Now the where is kind of where we can use both the frequency and we can also use something called rhythm. There are three things we can use: frequency, rhythm, and the 20 EMA. This is all part of behavioral response trading. This is something in my price action course. So let's start off with frequency. We've established that we want to get in 71% of the time. Does that mean we want to short on any single candle? No, it doesn't. Now, this is where we can really use frequency to our advantage. This is an understanding market rhythm. And this is a different way. This is a quantitative way to look at market rhythm. Concept number 2. What is rhythm? Does anybody know the dance, the cha-cha? Does anybody know that dance, the cha-cha? Or at least heard of it? Okay, so one of the rhythms, the main rhythm of the cha-cha is that it goes 1, 2, cha-cha-cha, 3, 4, cha-cha-cha. So maybe many of you have heard that rhythm. The rhythm is really established by what happens when, because we know the main steps. There are the main steps. Yes, 2, 3, exactly. And it's a little bit different than tango, which is generally on a 4 count, a 3 count or a 4 count. So cha-cha is on the 2, 3 count. And so the key in understanding the rhythm is not understanding the main step, but is understanding what happens when the market steps back. How often will it step back before it steps forward? And I'm not going to get into this because that could open up a huge can of worms. And that's actually how I kind of view Elliott Wave as worms. But I would not regard Elliott Wave as a rhythm. I would consider it too subjective. I'm actually talking about rhythm from a quantitative perspective, which is different than Elliott wave. Elliott wave is really not quantitatively based. It's more subjectively based. You can't base Elliott wave on pure numbers. It's not pure objective. Gives me worms too. Yeah, exactly. So that's just my thoughts on Elliott wave. You'll get to read more about my thoughts on Elliott wave in a book. But so to really establish the rhythm, if you are the main dancer, if you're the lead dancer, you're really concerned of not how is somebody going to make the main step, because we know what the main step is. It's predictable. In this case, it's short. The rhythm is when it takes a step back, what are the chances it's going to take a step forward? Now in Cha-Cha, we know it's a 2-3, so we basically need to know, okay, after so many steps, it's going to step back forward. Now apply that to the market. The rhythm is the step forward is the directional step. Since we're in a downtrend, that's the normal forward step of this rhythm or this trend, this dance. What we really need to find out is what is the rhythm when it steps back. In other words, when it moves counter trend. In this case, it's very, very easy. This is one of the most beautiful textbook examples. In fact, I use this all the way from here down. That's why I'm using this pair in this time frame, because I was trading it from here down. And so I was using frequency and rhythm to trade this. Now, what is the rhythm? Well, to find the rhythm, you only need to look at the blue candles, the counter trend candles. Now, can anybody look at the blue candles and figure out, okay, so the maximum rhythm, or in other words, the maximum step back that this pair is taking is 3 candles, 2 days, candles. So, and we're going to apply this concept of rhythm further on and out. So, what we know is that so far, to date, this thing has only taken 3 candles or 3 steps back before it takes a step forward. That's very powerful information for us to have. Not only do we have the frequency, but we have the rhythm. In other words, what are the chances that after a blue candle, or 2 blue candles, or 3 blue candles, that the market is going to continue to sell off again? That's very useful information. This is part of the BR trading, behavioral response trading. So, if you look at all the blue candles, we've counted it, there's 12. 1, 2, 3, 4, 5, 6, 7, 8, 9. Actually, it's not 12. There's more than that. There was 12 in the little sequence we did before. Let's count the total number from top to bottom. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Did I do that right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. 19 candles. 19 blue total. Out of all the 19 blue candles, only 2 of them, actually a total of 3 of them, were followed by another blue candle. So that, and what was that? This blue candle was followed by another blue candle. This blue candle was followed by another blue candle. And this blue candle was followed by another blue candle. Now, since I got the HotCom program locked on this chart, can somebody divide 3 by 19? I can't pull up the calculator program. I can do it, but then HotCom's going to lock me back out of it, and it's going to go right back to the chart. So, well, somebody, it's got to be about 15%. 6.1. Okay, so we're talking about basically 15%. Ooh, my math was good. 15.7. Okay, so about 15% of the time, if we see a blue candle, will the market be followed by another blue candle? If you knew that you had about an 85% chance after witnessing a blue candle that it was going to be followed up by another red candle, and the red candle is with trend, would you feel pretty confident about selling on open of the next candle? The formula is 3 divided by 19. The number of blue candles divided by the number of blue candles that were actually followed by another blue candle. So 3 divided by 19. 85% of the time, I'd be willing to bet all of you would be very excited to know that you'd have an 85% chance that the market was going to sell off. And you should. Because look what happened. Every single blue candle from here, I just jumped 1, 2, 3, 7 candles. I just jumped 7 candles ahead. Every single blue candle was followed by another red candle. That means that the next, let's see, you would have made profit here on the open of this candle. You would have made profit here on the open of this candle. You would have made profit here on the open this candle. That means 3 candles back to back after very large blue candles and a possible bottoming formation. When the market was thinking, shoot, maybe bottom here, you would have been making money every single day after a blue candle. We're going to take this a little bit further. But being able to understand frequency and rhythm gives you a different insight to the market because it goes beyond structure. It's talking about price's relationship to time as well. That's the other component to price action. Does it make sense? ¿Entiendes? And so Jay has a question here. Will this be suitable on hourly or 4-hour time frame? Okay, jumping ahead, but let's get into that. The analytics show that, and this is just my analytics, maybe they're incomplete analytics, but my analytics show, and please excuse me, I'm pouring myself a glass of water. Analytics show that this frequency and rhythm will work on 4-hour, and it slightly becomes a little less stable on a 1-hour time frame. So I will apply it to 1 hour. I actually will apply it to 5-minute charts. But I have to understand that the smaller the time compression, the greater the noise that's going to be involved in that time compression. Why? Because not everybody involved in the market is trading for profit. There are people who participate in this market who actually have no interest in profit whatsoever. And so because of that, they could be getting involved in positions that may have a short-term effect on the market, but are unlikely to seriously influence an entire day's candle or a series of daily candles or a series of 4-hour candles. So that is why I apply this primarily on 4-hour and daily time frames. And there's always a scalper in here that's always wondering, on a smaller time frame, would we only be looking to scalp? No, you wouldn't be looking to scalp. I'm actually not a big supporter of scalping. Partially because when I worked for the broker, I got to, as I mentioned in the last class, I got to analyze the top 1,000 accounts, and then I got to look at the top 100 and then break it down to the top 10. Out of the top 100, only one of them was a scalper. Only one. So if out of the top 100 traders, only one of them, 1% of the people is able to make scalping a profitable method, that tells me it's not a really stable method. It's a very difficult method to do. Kind of like Formula One car racing is much more difficult than racing go-karts. So I don't generally support scalping at all. What do non-profit traders do in the market? They scalp. So, yeah, okay. So why would someone be in the market and not want to make a profit? Very simple. Central banks will get involved in the market because they have no interest in making a profit. Their job as a central bank is to stabilize their country's economy and currency. They have many reasons. They have various reasons, but those are some of the main reasons. Multinational corporations get involved in the market with zero intention of making profit. Case in point, our friends Toyota, who are having a lovely time trying to deal with the whole braking issue, they make a lot of money in Japanese yen. But the problem is they have a boatload of employees in the U.S. I'm willing to bet those U.S. employees do not want to get paid in Japanese yen. So Toyota they have to exchange their Japanese yen to buy U.S. dollars. There's a lot of people who exchange currencies with no intention of making profit. Have you ever traveled to a foreign country and exchanged currency ahead of time? You didn't really have much of a choice in terms of you had to do it at a certain time. But yeah, you could try and time the market a little bit. But the bottom line is if you needed euros and you had dollars, you had to get euros. There are plenty of people who are speculating in the market with zero intention of actually trying to make a profit. So hopefully that answers your question. Okay, here's the beauty of this frequency and rhythm. Again, it actually doesn't care about structure. It doesn't care about structure. Why? And I'm going to midships questionnaire. Does the size of the tail or wick have no bearing, or is this important for your stop placement? This is a very good question. The size of the wick, it would depend on the candle. I mean, obviously we're talking about the previous candle, because with the previous candle, you don't have the current candle. We're getting on open of the next candle. So we have to actually look at, how do we apply a stop? There are a couple ways that you can, and we're looking at this specific section here, the bottom. There are a couple ways that you can look at stops. As I said before, this is my favorite method for doing that. Is that I simply take the previous candle, I cut it in half, and I get in on the open of the next candle, and I add 50%. Why? Because generally, when the market has broken through yesterday's high plus 50%, it's generally not returning back. Most of the time, it's not going to. You can get rejections, but a majority of the time, it's not going to. So that's why I would do that. What is the target? The target is very simple, the close of the candle. Why is that? Because we've established, and that's the beauty of this, is that the yesterday's close plus 50%. Yeah, you measure yesterday's high and low. So if we're getting in on the open of this candle, we take yesterday's high and from top to bottom, we cut it in half, and then we add that to the open of this candle. So we're getting in the open, we're looking to short. We take that half, which is 50 pips, and we just put it up there. That's our stop, and that's it. So hopefully that explains the strategy in terms of the stop. The limit is very simple. The limit is the close of the candle. Why the close of the candle? Why not an actual number? Because the bottom line is that we are already in a trend. We've already established the frequency that 71% of the time this market is going to end up as a red candle. We've also established that with the rhythm, that only 3 out of 19 candles had actually followed up with another blue candle. In other words, 15.7% of the time is the market going to follow up a blue candle with another blue candle. That means we have an 85% chance this candle is going to close red. So instead of trying to take profit at a certain level, we take profit when the candle closes. And then Radio Star says, you close the candle at the end of the candle. Okay, very good question. Yes to the first question, no to the second. We do not open a new trade at the end of the next day. Why? Because what would be the most optimal situation would be to wait for another blue candle before we get back in. So that is how we apply frequency and rhythm to the market. Now, there's a couple of things I'd like to talk about. Pattern finding. And let's apply this here for a second. Now, I want you to look at the market. I'm going to make this a little bit easier for you and a little bit challenging. And I'm going to answer your question, Squaw, in a minute. When do we stop shorting? I'll give you a short answer, and then I'll show you exactly how we do it methodically. When do we stop shorting? When the frequency and the rhythm get disrupted. So hopefully answers your question. And what moving average I'm using? I'm using 20 EMA. Okay. Now, we don't necessarily stop shorting when price moves above the 20 EMA. That's not entirely correct. And that's why I want to go over this point here called behavior response or pattern finding. Now, take a look at this. Here's the top of the swing. Now, look at this from here. Once we get below the 20 EMA, I want you to look at from, say, here, I'm going to mark it easy for you, here to, let's go to here. Okay, so I've put the goalpost up. From there to there, in between those two lines, can anybody see any patterns? Any. And while you're looking, I'll make it a hint. If you see any patterns, type them in. Don't just say yes and type it in for me. If you see any patterns, let me know. Okay, returns to 20 EMA and drops. That's not entirely true, though, is it? because it doesn't just return the 20 EMA, it's broken the 20 EMA a couple times. Two really base drops. Pennant, I'm not talking about price, not triangles or anything like that. We're not going to talk about any of that today, actually. Flags, none of that. One big fall by two short. Not entirely. We had one big here, and then we didn't have two short back to back. Head and shoulder, no, there's no head and shoulder. Head and shoulder is a reversal pattern that would happen at an ascending market, not a descending market. Bearish pin bars at the break. Yeah, but it's not really a pattern, though. Not really. I mean, you got one of them, but not really. Sort of. I'll give you partial credit for that. Downtrend, lower highs, lower lows. Okay, absolutely true. Consolidation. Okay, nobody's able to get it. Okay, before I answer the question, I want to go back to finding patterns. Let's say, and the large blue followed by two small is not entirely true because we have a large blue here and it's not followed by two small bars. Ooh, that actually would be considered a pattern. We're going to want to become aware of what is the stimulus that causes a reaction. We're not going to be looking for 100 stimuli. We want to find the one stimuli that causes a reaction from the market. And so with that being said, we want to use one stimuli out there. And that is why I use the 20 EMA. So with that being said, we use the 20 EMA as a reference point. Kind of like maybe we use food as a reference point for a little boy. We've got to use that one reference point to find out what is the reaction. Once we have a clear reaction and response, one stimuli, one stimulus, exactly as Mike said it, then we have a pattern that we can trade. We have a behavioral response that we can now trade. And so what we're looking for here is actually, I'll tell you the patterns that I saw, and that's what allowed me to trade this from here on out. Okay, first of all, I'm going to repeat all the patterns that I saw, because I had gotten, and I traded from here all the way down. The first I noticed was this. Every time it broke the 20 EMA, it was with a big blue candle. That was pattern number one. Pattern number two is the rhythm was exactly the same. One candle, big break above, two hesitation candles, one crashes below. One big candle above, two hesitations, one crash below. Therefore, the next time it breaks the 20 EMA, I'm going to be looking for this same pattern. If this pattern gets disrupted, then I'm going to be considering alternate scenario. This thing might be reversing. That is not my only pattern or reference point. Besides these little skirmishes above the 20 EMA, it also had a very direct response to the 20 EMA. Take a look at this one here. Boom, hits it, rejects off of it. Boom, hits it, rejects off of it. Boom, hits it, rejects off of it. So the three times that it actually touched it, not broke it, but touched it and rejected, were all red candles. On top of it, every time it rejected off of the 20 EMA, it followed it up with another red candle. Here, it rejected off of it, it followed up with another red candle. Here, it rejected off of it, it followed it up with another red candle. So therefore, I now have two very strong patterns in place. Actually, I have frequency at 71%. If the frequency gets disrupted, I'm going to be paying attention. If the rhythm gets disrupted, I'm going to be paying attention. If I get two or three of these getting disrupted, I'm probably not going to take any more shorts. I'm going to wait till they get reestablished again. So now, let's take a look at this here. This thing's hit a bottom. Look what happens again. If we had traded the pattern, hey, every time it rejects off the 20 EMA, it's going to sell off the next candle. Look at what happened when we had done that here. We trade on the open next candle, boom, it sells off. The pattern still holds. That's why we want to know these patterns, because as long as they are still valid, we keep trading them. Once they get disrupted, we no longer trade them. So let's take a look at this here. This looks like a pretty serious bottom. It definitely is a contender for a bottom. If we were to get a higher low, it would probably be a good chance that it is a bottom. And real quick, there's a couple questions here. Wesley, the second break through the 20 MA, you got a blue candle. How did you know it wasn't going to jump up more? This one right here, I didn't. I didn't. I just waited for this one right here to show the exact same pattern as it did. I wasn't trading this on the next candle. I wasn't selling off after this blue candle. And you're right, I didn't know. What I did do was wait for this pattern to possibly play itself out. Once it did, then I continued. Yes, EMA is set to the close. So I wait till the pattern establishes itself. Once it establishes itself, as long as it executes again, I trade it. Same thing here. We had 1, 2, 3 of them reject off of it, all followed by red candles. Therefore, even though I was sitting there going, shoot, this is looking pretty much like a bottom, we hit off the 20 EMA here, and I said, you know what, I'm selling on open, and bam, I made money on that one there. Now, take a look at this here. Please keep time for second strategy. It's 15 minutes left. All you guys care about is strategies, and I'm still actually trying to teach you a major important concept. So unless everybody is 100% sure that they got this, I'll move forward. But if everybody's not 100%, which they aren't because they're asking questions, go on. Okay, this is good. Cool. All right. Greedy boyki. Now, let's see what happens as price goes on. I was in this whole time here. I had sold off. Every time I saw a blue candle, I sold off. I kept selling off until I saw my pattern disrupted. Nothing was disrupted. I sold off on this one here. But then I started to say to myself, this is looking a lot like a bottom. Cuidado. Be cautious. Well, I was actually right. But take a look at what happened and how I was able to make my decision. 2 patterns were disrupted in the same candle. Actually, within the same sequence of 2 candles. One, take a look at this candle here. This candle is completely different from all the other candles that rejected off of it. How do I know that? Well, there's 2 things that are different about it. One, it rejected off of it, and it didn't end up a red candle. So I said to myself, wait a minute, I cannot trade on the open next candle because this is not another red candle. The second thing I said to myself is, wait a minute, all the other candles rejected off 20 MA and closed away from the 20 MA. This one rejected, it pierced it, but look what it did, it closed right next to it. So I had 2 patterns interrupted in one shot, and I said to myself, whoa, I better not trade this one. Then look what happens. The next day it follows up with a big blue candle, and I said, lucky on that one there. Then what did I say to myself? I said, okay, what would be the final confirmation that this downtrend is over? Not just looking at price structure, but to see if my patterns had been interrupted. And remember these patterns? 1 big candle up, 2 hesitation, 4th one slams. Look what happened. 1 candle up, 2 hesitation, 4th one does not slam. I'm now done selling. And guess what happens? It climbs for, 350 pips, 400 pips. And what happened here? I actually applied the same principles. Hey, after this, after I saw the pattern was interrupted, I said, wait a minute. Okay, let's see if there's now a new pattern. There's obviously clearly directional bias. How can I say that? Well, just like before, it was treating the 20 MA as a rejection point. Look what it did here, here, and here. Rejection, rejection, rejection. All of them closed up. Therefore, I want to look for possible rejections off the 20 EMA here. The other thing I did is I started calculating the frequency and the rhythm. The maximum it was ever to do was 2 candles before it shot a blue candle. So I actually waited till this candle right over here, and then I bought again. So it was very easy to take the same principles and follow it up in the opposite trend. How do I know when this trend is over? How do I know it's over? When the frequency and the rhythm get disrupted, or any of the patterns get disrupted. Did they get disrupted on this candle? Absolutely. We have a close below the 20 MA, and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 candles before it. None of them closed below the 20 MA. That's a caution sign. That's a big red flag. That is, hey, don't try and go long right now. The other thing about it is what did it do? It followed it up with another red candle. Ooh, I'm definitely not thinking about going long right now. And it disrupted the rhythm even again by doing 3 red candles in a row, something it had never done in this entire series here. Even from the bottom here, it had never posted more than 2 red candles in a row without posting another blue candle. So how did I know when the structure was changing? When the frequency and the rhythm were disrupted, or I had other patterns that were disrupted. Sploss says, what happens when there are 2 blue candles? Do I trade? No, I want to look for that rhythm. I want to know, okay, you know, this thing is only taking a maximum of 2 red candles. So if I see another 2 red candles set up, I want to go long at that point. Why? Because it hasn't shown 3 red candles in a row. So I want to look for the rhythm. So hopefully it answers your question. Not necessarily. I mean, it would be very hard to define the consolidation range on this one here. I could possibly define it as way down here. But yet on this candle, it didn't break the consolidation range. But yet it did disrupt patterns. That's why I'm not just looking at price structure. Okay. Midships has a good question. Do you find any currency pairs to trade with this style? Do some show patterns more regularly than others do? Here's the interesting answer to that. There isn't some that there is some that have a slightly more tendency, but the trick is not necessarily to try and find pairs that show this tendency more than others. The trick is to stay with the pairs that you are already trading and try and find out when it's in those environments. So instead of trying to, I could say a couple pairs, but if you're not trading them at all, you would have to kind of start over because you'd have to learn that pair again. So my suggestion would be you work on the pairs that you already are trading and see when these frequencies, rhythms, behavior responses patterns are clearly established and then trade them. Now, are there pairs that are less likely to show these? The answer to that is yes. And that's generally pairs with poor liquidity. So beyond the majors and beyond the yen pairs, most of the yen pairs, I wouldn't go beyond that looking for patterns. You can find them, but you're going to have less of a chance of doing that. Why? Because there's less liquidity, therefore there's less likelihood that you're going to have more of what we call the pure technical market. So hopefully I answered your question. Right now we're on the daily time frame. Time frames that I apply this to, my favorite time frames to apply this to are dailies and 4 hours. But I will apply this on 1 minute and 5 minute time frames. Now, I want to go over, or 1 hour and 5 minute time frames. Now, I want to go over one more example of this with there's so much material we didn't get to cover. Maybe we can do an extra class someday sometime or something like that. So there is one more pair I'd like to go over this with, and I want to go over another concept here. A different way to look at this mathematically. And let me stop chart for a second. Westlaw says, in your experience, are these rhythm and patterns also applicable to stocks, futures, and indices? Applicable to everything. Absolutely. Absolutely. I don't just trade Forex. I trade indices. I trade commodities as well. Bill Greggs is saying, and mega drawdowns at those pairs when entry missed. I didn't understand the first part of your question, so it's hard for me to respond to that. Okay. One more example, and then I want to show you how I look at this from another quantitative perspective. Here we're looking at a 5 minute chart on the pound yen, the beast as it's affectionately called. And I want to show you how we can actually see this. We have 10 minutes left before part 2. So you're saying, Maude, I just want to make sure I have 10 more minutes left? Because I thought we had a half an hour break and then we start the next one. Is that correct? So I have about 10 minutes? If you follow again for the moment, oh, okay. Cool. Great, fantastic. I appreciate that. Thanks for coming on board, Kathy. Thank you for helping me. How come wasn't giving me any love today? 10 more minutes and then 30-minute break. Okay, so it's 10 minutes. Let's go over this in 10 minutes here. I'm still missing actually 2 strategies, but oh well. So pound yen on the 5-minute time frame here. I want to show you this also from another quantitative perspective when we start looking at frequency and rhythm. Here we have a balance ratio. We don't need to do the numbers on this, but I did it anyways. These candles right here, from this point to this point here, 52% of them. So 52% of these candles were blue to red. So we're talking about the ratio from blue to red. Slightly more blue than red, but numerically, it's a balanced market, 52%. Okay, now, the structure starts to shift. We start to actually have lower lows here, and then we start to go into a dive. From here to here, the numbers actually go to 46%. In other words, there was only 46% blue candles and 54% red candles. That means we had a 6% decrease in blue to red candles. So we actually had a numerical shift. That's powerful for me to know. Now, from here all the way to here, we had another structural shift. We went from blue to red, red becoming dominant to blue to becoming dominant. And I'm going to show you this in actual numerical form in just a second. From here, we went to 55% blue to red candles. In other words, 55% of all these candles here were blue. So we're kind of still teetering around the balance, but the market is slowly shifting. We started at 52, we went to 46, we went up to 55, and then from here to here, the number goes to 44%. We've now had a lower low in the amount of blue to red candles, a very huge structural shift, and an 11% adjustment. Now, from here to here, only 10% of the candles are blue. From there to there. That means we had a 34% adjustment in there. Let's take a look at this from a numerical perspective. And you'll understand the point I'm trying to make here. Imagine if you could see simultaneously or really understand the market from this quantitative perspective. Imagine if you realize, okay, right now 52% of the candles are blue in relationship to red. Oh, wait a minute, it just dipped 6% to 46%. This might mean a possible structural change. It then jumps up 9% to 55%, but then from there it goes down 11%. Who's winning the battle? If you were watching this as a football game, American football, one advances 6 yards, one advances 9 yards, the other one advances 11 yards, who's winning the game? Well, the one that's advancing to the 6 and 11, not the 9. And then look what happens after that. In the next leg, the market goes from 44% blue to red candles to 10%. So imagine this on a linear football field. You had 6 back, 9 forward, 11 back, 34 back. That's a touchdown. That's pretty far back. So if you were to see this on a back and forward ratio, it would look clearly like, oh wow, the market's becoming imbalanced, I want to trade that. So by having this quantitative perspective, we can now see when a balance or imbalance is now coming into the market. Here's the numbers, just an increase and decrease. 6% decrease, 9% increase, 11% decrease, 34% decrease. If you were to see this graphically, this is what it would look like. 6% decrease, 9% increase, 11% decrease, 34% decrease. So this is also, ironically, the shape of the price action. Very close to it. By seeing it from a numerical perspective, we are now seeing the frequency and rhythm of the market as it's going from balance to imbalance. Do you see how that could be very powerful information? Being able to see the market in that perspective as well. It's a little quantitative, but isn't it too late once it hits 10%? Not at all. Why would it be too late? Why would it be too late? Again, when do we trade a pattern? We trade it until the pattern is interrupted. We keep trading it until it's interrupted. Okay, Rish has a question, and then I want to go back to some charts here. And then I want to see if I have enough time for I have enough time for one brief strategy. And, oh man, did I get rid of that chart? I can't believe I did. Okay, so I'm going to answer Rish's question and put up a chart at the same time. Rish's question here is, how do you know where to start end counting the blue-red candles? In other words, how do you know what sample to take and when to end? It's a very good question. The answer to that question is really in being able to detect the swing. Detect the swing highs and lows, basically, and when you can see that there's clear directional bias. If we remember, how do we determine clear directional bias? We use the 20 EMA for that. We use the 20 EMA and we try and see it visually. Now, this is going to be a lot easier on daily candles than it is going to be on 1 hour and 5 minute candles. That's why I apply this to daily candles and 4 hour candles, because you just get much more clarity of a signal. You can try it on 1 minute, 5 minute, and all that, but you're just going to get a lot more noise. When you start doing it on 4 hour and daily candles, it doesn't become that complicated. You start doing it on 5 minutes, it becomes a lot more difficult. Okay, one last thing here. I'm going to do this in 5 minutes here. It's called with trend setup. Have you ever been involved or seen a trend and then sat there and said, shoot, this trend has started. How do I get into it? I mean, you don't want to sit there and say, hey, this trend has started. I don't want to get into it. That's just silliness. You have no idea when the trend's going to end. And until the trend has showed you that it's going to end, the bottom line is you want to keep trading it until it's actually demonstrated it's going to end. So with that being said, there's something called, let's get the chart up, with trend setups. And this is called the EMA failure. And this is why I use the 20 EMA. If you have a pretty solid trend in place, and I would say at this point, here we've hit a top. Here we've hit a top at 130. And then what do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 out of 10 red candles, 1 blue. Now look what happens here. This thing now quickly, with the parabolic curvature, breaks above the 20 EMA. Anytime we have an established trend in place, and I see the market retrace back to the 20 EMA, I will sit there for 3 to 4 candles, and I will watch that. What am I watching for? I'm watching for a failure for the market to break back below the 20 EMA and continue the trend. I usually wait a maximum of 4 candles, usually 3. And what I'll do is I'll sit there and say, okay, let's see what happens over the next 3 candles. If within the next 3 candles, the market A breaks back below the 20 EMA, or B, not just breaks back below it, but does it with vigor, then I will get in what is called with trend. I will take that with trend setup. And what will I do? I'll wait to the close of that candle, or I'll wait to the next retest of the 20 EMA. Where will my stop be? Above the previous swing high here. You will see this on almost any time frame. I could show you this on a 5-minute time frame. I can show you it on a 30-minute, 1 hour, 2 hour, 4 hour daily time frame. Doesn't matter. When you have a clearly trend established in place, the market will generally do a couple things. And go ahead and look back on the charts and find trends. You will see that the market usually did a couple things. It either did A, rejected off the 20 EMA like it did here, here, and here, and then continued with trend, or B, it broke above it for about 2, 3, 4 candles and then slammed back below it. That slamming back below it is suggesting, hey, you know what? This break right here is not legit. If it was legit, it would use this as support and then start bouncing off of it. The fact that we've just slammed back below it suggests that the sellers are not ready to give up control and they're willing to re-exert force. Institutional traders don't just pile in a trend and then it hits the bottom and they get out. They know the market inhales and exhales. They know the market will oftentimes revert back to a 20 EMA or subtly break a 20 EMA. This slamming back below it is the market coming in again, the institutionals coming in again saying, guess what? We know this break above the 20 EMA is not legit. We are going to sell again. The only way you can get a big powerful candle like this 2 times in a row is if the institutionals come in and sell it. We know it's not the retail traders. Right now, retail traders only comprise about 110 billion of the market. The market's 3.2 trillion, aka 3%. We are only 3% of the market. The people who are causing these big candles are the institutions. They know this trend is not over, so they slam it again. They look at this as an opportunity to buy it cheaper. That's what institutionals do. So take a look at this. Next time when this class is over, if you're not in the premium session, go look on the charts, any time frame, and find some trends. And then tell me if you saw the market do one of those two things. Reject off the 20 MA and then continue, or break above it and within 2, 3, 4 candles slam back below it and continue going. Tell me if that happened. Email me about it. I'd love to hear about it. I'm pretty confident the answer is going to be yes. Okay. Chaos theory. So that was the last one here. I want to answer 2 last questions and that's it. We'll have to wrap this one up. Is there a minimum number of daily candles you wait before new bias is confirmed after what looks like a reversal? There's not a minimum number of candles. The answer is actually, again, in the frequency and rhythm. I look for those to be disrupted. So if we had a maximum of only 2 blue candles back to back, I would look for 3 candles. I will look for a disruption of that. If we had just like this one here, I would look for the frequency to change as well. If we were at 70% red to blue candles, if it started going to 60 and 50%, I would view that as the structure is changing or the market's balancing. What would be another way is, again, what were some of my established patterns in play? It would slam above the 20 MA with a huge candle, 2 indecisive candles, slam back below it. Breaks above it, 2 indecisive candles, slam back below it. I would look for that pattern to be disrupted. If that pattern was disrupted, I would be it would be very unlikely I would take that trade in the same direction as the original trend. So I'm looking at it in such a way as I'm looking for patterns to get disrupted. Remember, as long as the pattern is still in play, we keep trading it. That's the whole methodology behind trading a triple bottom. The double bottom's still in play, so we trade the triple bottom. That's the whole methodology behind that. Okay, so I really don't have enough time to get into anything else at this point here. Ironically, the last section of this class was going to be on pin bars, but unfortunately we don't have enough time for that. So we will have to take a break now for the next premium class. Hopefully you all are going to be at that class. If not, before we say goodbye, I want to say thank you all very much for coming. It was awesome having you guys here. Excellent questions, super engaging. I have no idea how an hour and a half flew by super fast. If you want to learn more of these concepts, there's a couple ways you can do it. As Maud mentioned, I have a DVD that teaches a lot of these concepts and some strategies on how to spot reversals, how to trade pivot points, how to pick out these patterns. I have a DVD for that. I also have a website which has online courses which teach you various different methods as well, price action courses. I have a pure price action course, pure Ichimoku course. So either one of those would be ways to learn this and take this to the next level. So that's it. That's my website down there, secondsguysforex.com. I hope you guys check it out. I hope to hear from you. Until then, I want to thank you all very much for coming. I want to wish you all good luck trading. I hope this has changed the way you look at price action. And if I could say anything about it, and I'll type in my email here. Sure, absolutely. info@secondskies.com. If you could take away anything about it, remember the frequency, remember the rhythm, remember to find patterns, and remember you can't just look at price action in terms of structure. You have to look at it in terms of price's relationship to time. So that's pretty much it. So I bid you all adieu. I wish you all good luck trading, and I hope to see you on the premium session or hear from you on my website. Until then, take care, everyone.